You are listening to Keystone Stock Talk Show, episode 321. It's great to chat with you again. Next week will be our annual prediction show, and we will be joined by a new contributor. So stay tuned for that first prediction show, or only prediction show of 2026. This week, I kick off the show by reviewing a long-time recommendation from our Canadian income stock research, Amerigo Resources Limited, symbol ARG on the TSX, a cash-rich, dividend-paying copper tailings processor in Chile. The stock is now up well over 250% since our initial recommendation. I'll let you know where it is today. Brennan has put together a special segment on the proliferation of financial scam ads he's been seeing in recent months entering 2026 and what to be aware of to help you avoid these money-losing schemes. And in our Your Stock, Our Take segment, Brett concludes our first show of 2026 by answering a viewer question on Premium Brands Holdings Corp, PBH on the TSX, a specialty food and premium food distribution company making products like sandwiches, processed meats, deli items, and baked goods. The company, which we monitor closely, is expecting potentially higher earnings in 2026. Brett will let you know his take on the stock. All right, let's get to the show. I welcome my co-hosts, the Killer Bees, Brett and Brennan. And we tease that we're going to have a new addition to the show next week. How are you guys doing? How was your New Year's, Christmas, all that?
It was great. Yeah, it was a lot of fun. But it's nice to get back at it. You know, I before the show, I asked you guys, I was like, what time do we record the podcast again on Mondays? I can't remember.
Yeah,
but, you know, it's been a bit.
You have short-term memory issues, so. And long-term too. So it's good. Maybe just memory issues, right? Yeah,
just probably memory issues. Yeah.
Christmas is good. Did you have a white Christmas?
Oh yeah, it's always a white Christmas.
Yes, I thought so.
I
mean, we asked that. I asked that in Vancouver. We had about 28 people at our house, which is not the record. We've had 38 before, but I have 4 sisters, so a large immediate family. But it was good. But we didn't have a white Christmas in Vancouver. I did up at the cabin have a white Christmas, white New Year. They got a dump of 4 or 5 feet of snow, which was crazy. Went up skiing, which was kind of cool. Hadn't been skiing in about 28 years, and my daughter just started. So I was, when I got up on the first lift, I'm like, holy crap, did I forget how to ski? But I found, as I'm looking down, I'm like, oh, I went right up to the top, and I'm just like, but then I was like, okay, it was like riding a bike. I heard it can be, and it was more. I mean, I had to be cautious the first time. I was a little younger the last time I skied. So I'm like, yeah, I'll be a little bit cautious so I don't blow out a knee the first run. I literally saw somebody basically do that on my second run down, a guy that was like putting on his skis in the same area. I saw him down. I mean, I shouldn't be smiling, but he was coming down the hill. I think he was fine. They said, are you okay? Yeah, it's just a knee sprain or something. But saw him on the cart, hauled down with the the ambulance lights going and everything. Yep. And I'm like, oh my God, that guy. Because I remember the guy had said, yeah, I haven't skied in years, and I tied one on because it was New Year's Day, and he was just like, or basically around that time, and it was just like, oh man, you could tell he was hurting, and he probably was not in the right state of health to be skiing, but yeah, he taken off. He was okay, but it was fun. It was good. Christmas is awesome. Now we're back at it. And everybody will be telling us what are your top stock picks for 2026. So we're going to get those to clients. We've already had one recommendation go out, an infrastructure company in the Canadian market, trades at about 5 times our expected earnings this year. And we have a cash rate or net cash Canadian small cap report going out over the next week to 10 days. So we'll get to that. We're looking at Canadian Dividend All-Star. We're looking at U.S. net cash, large U.S. net cash, small cap over the next coming months too as well. So should have some new recommendations coming out of that. Markets are pricey overall right now, but you always do find value. This time last year, we thought the markets were very pricey, but we were able to buy a company like Group Dynamite at like 10 to 12 times earnings. And that company has, gone from $16 to 80 plus. So there is value. you got to really scrounge the markets right now to find it. But overall, I think the markets are pricey, but we're finding some individual value. That's what I'd say where we are right now.
For sure.
Anything further? Anything you want to tell me about?
Just Santa Claus got me a bunch of new dress shirts, so
Nice.
I'll be stunting on the podcast with some new dress shirts from Santa Claus.
Looking sexy, Brennan. That's what
my
Brett
mother
said earlier.
That is what I said.
Yeah.
Yes.
Good.
But no, I mean, it was just it was a good break. I'm excited to get into some really good research. This for 2026. I also played some shinny or some hockey with some buddies.
Nice.
On New Year's Day, so that was a lot of fun.
Really, were you hurting that day, or?
Well, yeah, I mean, I was hurting that day, but I really realized how out of shape I am. I always think when I get on skates, I'm just going to kind of float around out there, just kind of stride around. No, that's not how it goes. It's a lot of work out there. No wonder, guys are only putting up 30-second shifts
well, the older you get, the brain knows where to go, the body doesn't get there as fast, so yeah, that's what happens, right?
Yeah,
we'll see. But my dad's 83 and he's still playing hockey, so we have no excuse, right? He's still on the ice. He'd
probably skate around me. Yeah, he'd probably skate circles around me.
That's not saying much, though, let's be honest.
No, it's true.
All right, should we get to the show? I think we'll get to, I'm going to review a company that we got a question on. The metals segment is hot right now, and this company is tangential to that, a processor of copper. So I'm going to share my screen first, which is always an eventful occasion, especially when we're getting back at it. And you'll tell me if it actually works, right? So the company that I am going to talk about is Amerigo Resources Limited, ARG, on the TSX. Trades around $4.82, about almost an $800 million market cap, pays a 4.46% dividend. There is also a special dividend that it adds to that. So what does Amerigo do? Through its 100% owned Mineral Val Central SA, or MVC, it is a producer of a copper and molybdenum concentrates. Operating in Chile, Amerigo produces copper from waste material of the world's largest underground copper mine, Codelco's El Teniente mine. MVC is located in Chile and has a long-term contract with, I'll just say, Codelco's El Teniente division, or we'll call it the DET, to process fresh and historic tailings from El Teniente. MVC currently operates under a tolling agreement with DET and the title to the copper concentrates produced by MVC remains with DET. MVC earns copper tolling revenues calculated as the gross value of copper tolled on behalf of DET at applicable market prices, net of notional items, which include treatment and refining charges, DET copper royalties, and transportation costs. So since 1992, Amerigo's simple and proven technology has produced 1,020 million pounds of copper. Amerigo provides investors full exposure to copper prices, sustainable operations, and a simple business model with predictable operations and cash flow. Amerigo is committed to returning that cash flow to shareholders through a leading capital return strategy. It's CSR, which includes quarterly dividends, share buybacks, and performance dividends. Amerigo's CSR has returned $93.7 million to shareholders since October 2023. There is the company has what we call a sector-leading dividend yield. Unlike many copper miners that reinvest heavily in high-risk exploration or new mine development, Amerigo returns a significant portion of its free cash flow to investors. This has resulted in a dividend yield that is consistently sitting at the top tier of the copper sector. It's often been 8 to 10% and even exceeded that. Right now, like we said, it's lower with the share price surging about 200% over the past year. While many traditional and copper producers and explorers offer low to no dividends. So it has a yield plus model. Amerigo combines a sustainable base dividend with opportunistic share buybacks. This dual approach allows the company to outperform the sector during periods of stable copper prices as investors receive a tangible return rather than relying solely on the volatile share price appreciation. It is exposed to copper pricing, however. Operational insulation, because Amerigo is a processor of rather than a traditional miner. It avoids the massive sustaining capital cost of underground mining. This lower intensity CapEx requirement leaves more cash available for its CRS, even when copper prices fluctuate to a degree. So we look at the stock performance over the past year. Stock just in the last year is up 200%, and we'll show you why. It has achieved debt-free status, and this is allowing further dividend increases. Amerigo has successfully transformed into a debt-free entity, a milestone that serves as the primary engine for the aggressive shareholder return model. Here is a summary of how this was achieved and what the payout it means for future payouts. So the company's journey here involved a disciplined 10-year strategic cycle focused on non-dilutive growth. It started around 2015 to 2017. In that period, Amerigo funded the expansion of its MVC facility through two major debt tranches, totaling almost $100 million. This allowed the company to grow production capacity without issuing new shares and diluting existing investors. Restructuring happened in 2021. The debt was restructured in this period, providing the financial flexibility needed to launch the CRS program. The shift allowed the company to begin returning significant capital. Even debt was being paid down at that period. Full repayment by systematically retiring this debt. Amerigo has now reached a zero debt position, having already returned $93.7 million to shareholders since the CRS began. Let's look here, the dividend upside in this company. The elimination of debt has created a significant cash flow windfall at current prices that is being directly funded into shareholder returns. So they have gone to now a zero debt pure payout phase. With the debt gone, Amerigo has shifted into this growth and repayment from the growth and repayment phase to a pure payout phase. In 2025, in December of 2025, the company further demonstrated this by declaring its second performance dividend. That was about 5 cents per share Canadian, bringing the total 2025 payout to 18 cents per share. As long as copper prices remain strong, it's about it's about 350 or above, but really it's about to 420 in that range, but I'll get into that in a second. The company maintains its $25 million cash flow. Shareholders can expect the base quarterly dividend to be supplemented by these opportunistic performance payouts and continued share buybacks. Shareholders should expect the performance dividend to become a recurring feature of the capital return strategy as long as copper remains, it is at the 420 to 440 per pound range. We do caution, though, that copper prices are volatile and in economic declines can easily drop below 420. Let's look at the most recent quarterly results. As we see here, tremendous jump in net income on a per share basis. That's CAD dollars, so up about 200% per share. Operating cash flows up 39%, free cash flow 88%. Cash costs were an improvement to 180 from 193 pound. Despite a 10% decline in copper production, the company was able to more than double its net income, primarily through favorable market pricing and a much leaner cost structure following its aggressive debt restructuring. Let's look at the key drivers of this financial growth. Copper production, like we said, fell to 14.6 million pounds versus 16.3 million in Q3 of 2024. But this was primarily due to a temporary suspension of fresh tailings throughput following an accident at Codelco's El Teniente mine. Earnings were bolstered by the following factors. Strong copper pricing. Obviously, Amerigo realized an average copper price of $4.54 per pound, up from $4.22 a year ago. Furthermore, the company benefited from $1.3 million positive fair adjustment on receivables due to rising prices, a sharp reversal from the $2.7 million negative adjustment seen in the prior year. So that kind of juiced earnings year over year. Reduced smelting and refining charges. These costs dropped by nearly 47%, significantly padding the bottom line. Molybdenum byproduct credits. Stronger prices provided a 25 cent per pound credit toward copper production cost, acting as a massive offset to the rising inputs like power and lime that they use in the production. Or debt reduction impact. The company's push towards debt-free status that was finalized in October contributed to improved working capital and lower interest obligations, allowing free cash flow to equity to nearly double. Now, let's look at our outlook on the company. Near term, their Q4 2025 outlook, production growth. Management confirmed that Q4 2025 is expected to be significantly higher than Q3 2025 due to, the reason was the artificially low, and we talked about this production in Q3. Now, the outlook for 2020, a little bit longer term here, 2026 and 2027, the management is looking for production declines. They've been transparent that production would most likely see a modest downward trend in the coming years. The reason is due to the natural depletion of the historical tailings deposit as MVC, Amerigo's subsidiary, processes the remaining material. The grades are expected to decline slightly over the next 10 years. The CEO has consistently messaged that Amerigo is not a production growth story, but rather a cash flow per share growth story. So let's look at the valuations here. Amerigo trades with a PE trailing basis of approximately 27, a number we expect to drop to the range of 20 when the 2026 expected EPS are out. If copper stays in a favorable range, the company trades at its highest PE over the past year and a significant premium to the 5-year average in the range of 15. It has been very volatile. We expect a very strong Q4 if copper remains in its current range over the course of 2026. EPS should move higher. At 15 times next year's expected earnings after adding back next year's expected year-end cash balance, we view fair value in the range of 350 to 450. That is with copper above the 420 to 440 range. So the conclusion here, debt-free milestone and near-term strength. Amerigo enters 2026 in its strongest financial position ever, having officially achieved debt-free status in late 2025. A significant operational rebound is expected in Q4 2025 following temporary production suspensions, was combined with higher copper prices should drive record near-term cash flow. But valuations are stretched and could be near cyclical peaks. The stock valuations have become historically stretched, trading at a trailing PE of 27, a massive premium to its 1 to 3 year average of roughly 15 times. With the underlying commodity at cyclical highs, there is significant risk of rapid contraction in both earnings and multiples if copper prices soften. Production headwinds, 2026 and 2027. While management has pivoted to a cash flow per share model, physical production is entering a modest downtrend cycle. The natural grade depletion of its historical tailings deposit remain fundamental long-term constraints that limit volume growth. We'll look at potentially unfavorable risk to reward right now. It has surged over 276% since our original recommendation. The stock is trading now near all-time highs and exceeds our near-term fair value, $3.50 to $4. Now, while a strong Q4, which is expected, could provide another leg up, risk has increased given the cyclical nature of the business and the lack of production growth. Gains are powered by price of copper right now, which is historically volatile, and we do expect production declines. We have recently updated clients. We would just monitor and not enter new positions at this stage. And that concludes my little snippet on Amerigo.
Perfect. Yeah, I spoke with a client recently, and she indicated that Amerigo had become one of her largest positions, given the strong gains. And I look back at my emails with her, about a year and a half ago, 2 years ago, and she indicated this article and said, is it time to absolutely load up on Amerigo? And I said, we're going to expect volatility in copper. We don't know where it's going to go, but we like the business. Good balance sheet, good dividend, and like looking at a Peter Lynch quote. I'm always bringing up Peter Lynch quotes. In One Up on Wall Street, he says that the most important question to ask about a cyclical is whether the company's balance sheet is strong enough to survive the next downturn. I would say that yes, Amerigo does have that solid balance sheet to survive the next downturn, which will inevitably come with a business like this. So it can be diligent, to take profit on these types of businesses that are cyclical, are reliant on commodity prices.
Yeah, in cyclical names, copper trades at all-time highs. If it sustains that price, these companies will be extremely profitable. And it always looks like you get fear of missing out in these companies. It's typically the right time to take some profit. So, I mean, I would not be opposed to somebody taking some profit. It looks great right now. Everything is lining up. If copper keeps going higher this year, then the company keeps going higher. That can happen. But in cyclical commodity businesses, it can turn on a dime. And when you've made a good profit in a company like that, at least taking some off the table is often a good strategy. There are less cyclical businesses that we can buy at a similar multiple right now. And, if you could recycle at least some of that into a less cyclical name, you typically, if you're looking to hold that 3 to 5 years, you're going to go do better over the long term. So, we take some profits on a name that, people are now asking, oh, can I get into copper today? Well, the time to get in was several years ago, when we were originally buying Amerigo.
Yeah,
those are the right times to buy.
Yeah, it can go up, down just as quick as it went up. It went 200% up in the past year. It can go back down if copper declines, if we have some geopolitical catastrophe, which causes mass destruction of demand. Because right now the whole copper story is that global supply decline over the next 5 years, and that's why you have these prices going higher and higher. If that story breaks, you see copper decline, then America goes back down 60-70%. Back to that when it goes down to that 420 range.
It's very hard to predict the macro in terms of commodity pricing. It's hard to predict earnings in any company, but less cyclical names, it's less difficult to predict. And you don't have that overlay of the volatility of the commodity. I mean, this management team could do everything right. They could even increase production where they're saying it's going to decrease. If copper goes down 30% this year, the share price will not do as well. Even if the management team is doing everything right, they're increasing production, say 10%, where you thought it was going to decline, and that's sustainable going forward. The price will go lower through no fault of their own. So, if you have a less cyclical or non-cyclical company where management does everything right, it's trading at reasonable valuations, the stock goes higher. You don't have the extraneous factors that you have with this, where you're trying to predict where the commodity goes that they have no control over. And that's why these type of companies shouldn't trade at premium multiples.
Yeah, it's extremely hard to predict. And even in the last webinar, which we did, I went over this and looking at the back or the last bull cycle for gold, and how, I pulled up TD analysts, HSBC. I pulled up several analysts who were expecting, gold to surpass, $2,100 per US ounce back then. But and with a floor of like 1,700 or 1,600, over the next 3 to 5 years, we saw, gold come down to like $1,200 per ounce. It's just, again, no one knows. And it is interesting looking historically at, what analysts were saying and, if it played out to their expectations. Most of the time it doesn't.
You have to, in terms of valuations, you have to buy these type of companies. You have to know they're very cyclical. You have to buy them if you want any margin of safety at a significant discount to their average price to cash flow, and you got to smooth out peak valuations and all that. But we were buying like 6 to 8 times. Mm-hmm. And now you're talking about like trailing, and now you're talking about 27 times. So Amerigo's next quarter is probably going to look tremendous, and maybe it has another leg up. But if you're not taking profits of 200% in a year on a cyclical company, and recycling that into some less cyclical, or buying a cyclical name that has lower historical valuations, because you can find those. There's some names out there now we can buy at 8-10 times earnings that I'd rather recycle into, and they're paying yields as well. So it's this company can do very well this year if copper like goes to $6, $7, $8. Like or if it stays in its current range, it's going to kick off a lot of cash flow. You're talking about all-time highs. Does it stay there? Historically, no. I mean, it's an all-time high unless we keep breaking that, of course. Let's move on. Brennan, speaking of, you've been seeing a lot of scams lately.
Tons. Yes, tons. Every single time that I go onto my phone, if I'm on Instagram, I probably, I get served just one after another. And it's probably because, I'm doing this segment. I've been, stopping on them, taking screenshots of them, clicking kind of like through some of them just to see. So I'm probably getting in the scam algorithm kind of. I'm easy.
And because you've been taken so many times by these scams, right? It's like, we all know. Brennan, stop investing in the Sheik from,
Yes. Okay. I'll share my screen here.
You know what's funny? I got a letter that I should pull up right now that is a scam. Can I grab it? It's right over here. Hold on. You go into this right at the end of it. I'm going to walk off. I'm going to grab it. This is the more traditional scam where you get a letter in the mail, but I got to show this. So you keep going. Go.
Yeah, I'll jump into this here. Okay. So in late 2025, there was a Reuters investigation that revealed that Meta, the parent company of Facebook, Instagram, and WhatsApp, has allegedly tolerated a massive volume of fraudulent advertising to protect billions of dollars in revenue. And looking globally, internal documents showed that in 2024, roughly 10% of its global revenue, or about 16 billion, came from ads for scams and prohibited goods. Now, Meta reportedly formed a specialized anti-fraud team to target Chinese scammers, which successfully reduced the prevalence of prohibited ads from 19% of China revenue, or about 3.4 billion, to about 9% by late 2024. But Meta disbanded the initiative, as Reuters reports that this decision was made to safeguard revenue, leading to a rebound in fraudulent ads in mid-2025, now back up to approximately 16% of China-sourced revenue. Now, internal documents also show Meta's automated systems often require a 95% certainty of fraud before banning an advertiser. And if the system is less certain, but still suspects a scam, Meta allegedly charges higher ad rates as a penalty rather than blocking them, essentially profiting more from high-risk ads. And anecdotally, like I was saying, I'm bombarded by these fraudulent and scammy ads on Instagram and Facebook, indicating that TD or RBC, Questrade, or some celebrity wants me to join their encrypted WhatsApp group with the potential to make some quick money. So this is why today I wanted to do a bit of a public service announcement and review a few of these actual scam ads that I've been served. And, there's thousands out there. So, just be careful. And these are actual ads that I got served. So let's get into it here. So the first ad, which I'll be touching on, is an apparent endorsement from Kevin O'Leary, who indicated that he recommended individuals buy Open Door Technologies, or OPEN, on the NASDAQ, I believe, at 68 cents, and let individuals know to sell it just 3 months later at just under $9. So I'll click to play the video here, or the ad.
I recommended that you buy Open Door Technologies Inc., Open, stock at 0.68. 3 months later, I told you to sell it at 8.92.
Okay, so clearly after watching the ad, we can see that it is a sloppy AI voiceover of Kevin O'Leary. It's quite grainy, as you can see. His mouth is kind of like blacked out, or you can't really see his mouth moving. And realistically, these individuals, or whoever's making this ad, are trying to generate some excitement around a stock which went up in a short period of time, which, as far as I'm concerned, was for absolutely no apparent reason. And it is a little bit of a high flyer, this stock. I know even, back in 2022, one of my friend's cousins, he was all about this stock, but, he lost a lot of money on it. And of course, this ad doesn't state any reason why they had expected the stock to increase in value, but just that it had gone up. So, it's definitely a scam. Now, realistically, I do not have to go over, the fundamentals of Open, as again, the ad is just arbitrarily looking for a stock which went up in a short period of time. It could have been any, business or any stock that went up. But fundamentally, I just wanted to say that at this stage, I wouldn't touch Open Door Technologies with a 10-foot pole. If you zoom out, we can see that the stock has had a tough last 5 years, dragged down by negative revenue growth and a lack of profitability, with the company now jumping onto the AI hype train in November of 2025, indicating that this is what will lead the business to profitability, despite never being able to make profit, even going back to 2017. Maybe they can do it, but I'm not a believer that AI will be their savior to tap into profitability. Now, Kevin O'Leary never really endorsed the stock, obviously, and I would like to think that he never would, given its horrible fundamentals. And just a note here, I reported over 30 ads like the one that we just went over here, and like the ones that we're going to go over today. And this one of Kevin O'Leary is the only one which was actually taken down after I reported. Now, the next here is another sloppy AI voiceover of Vlad Tenev, the CEO of Robinhood, apparently sharing stock ideas to a limited number of investors. And I'll just quickly play this ad as well.
Hi, I'm Vlad Tenev, co-founder and CEO of Robinhood. I've got something exciting to share, just for serious investors.
Now, if you click through to join the community now, you get the following message that indicates you are to receive a stock which is projected to rise 45% within 5 days. Now, of course, this is just way too good to be true. And if you read it closely, you can also see that it is written quite poorly, such as saying spaces are limited. And the scary thing is that after clicking on this ad to see the sign up form, for the next week, I was getting served the exact same ad dozens of times from completely different accounts. I reported every single one, but Meta indicated to me that none of the ads violated their policies. But I knew it was a scam. Now, let's go over to a couple more here, just the last few. So these are just a couple random ones that I was served. The first here, these are kind of more just funny, I thought. The first here indicating that if someone buys 200 shares of this unknown stock trading at 80 cents or a whopping $160 in total investment, they would have $980,000 in just 3 months. This is insane and super comical. Like, this would equate to a return of over 600,000% in just 3 months. And why didn't they just round up to 1 million? They say 980,000. Why didn't they just round up to 1 million? I just find it interesting that they say, 980,000. The next, they indicate that just a month ago, this group indicated to buy CP Rail at $73.12, and the stock is now up 4.6% to $76.49. Now, again, I'm showing this one as I just find it hilarious that they're citing a 4.6% return over 1 month as being something to write home about. So what are all of these ads trying to achieve when they're asking you to join their scam encrypted WhatsApp groups by promising easy returns? Well, these groups are filled with bots or other scammers posing as successful investors who post fake screenshots of their massive profits to lure you into a false sense of security before asking you to either send money to a fake trading platform or perhaps trying to pump and dump a specific stock on the market to their network of fake investment groups. And this is why a lot of the times you'll see them, posing themselves as TD or Questrade or Robinhood, because, they're basically wanting you to send money under the guise that your money will be going onto a TD account or a Robinhood account, etc. So, of course, just to finish this segment, it wouldn't be complete without a few wise quotes from Warren Buffett and Peter Lynch, my two favorite investors. Number one here, if you lose money fast in the stock market, you can't make it fast. Another one here is when Jeff Bezos met Warren Buffett, he asked, "Warren, your investing strategy is so simple. Why doesn't everyone just copy you?" And Warren responded, "Because nobody wants to get rich slow." And Warren also says, "Keep things simple and don't swing for the fences. when promised quick profits, respond with a quick no. So yeah, that's just a quick segment, kind of more of a fun segment, heading into the year. And yeah, I'll open it up to the guys if they have any comments, and let's also take a look at Ryan's letter that he got if he has it handy.
Well, we're gonna have to do my letter next week. I just remembered I filed it away, but it is somebody with my surname from somewhere in Europe that I am going to inherit a fortune from. So I'm going to, it's great. I'm sure we'll reply, and I'll get millions or billions from that Irvin fortune somewhere in Europe. Yes, but yeah, no. On those scams, I mean, I received them. I just don't even pay them any attention. It's a lot of FOMO that people they play on, fear of missing out. Look at this tremendous return you can get. I mean, the crazy thing is, getting rich slowly is great, but I mean, we just talked about a company in Group Dynamite that you could have made with a real investment, with a real, you could have a $25,000 investment. Like, this is real. This isn't a scam, but a $25,000 investment would be worth $126,000, just at the start of last year to today. I mean, those are actual returns. You're buying a company 10 to 12 times earnings. Now that doesn't happen all the time, but it's one of our top picks from last year. Why not just invest in really good companies, position your portfolio to benefit from great businesses such as that can provide you with the blue sky returns without the risk. You can't invest, $5 and be worth 120,000 at the end of a year. Or you can't, I mean, in most of those cases, if you're asked at 25 and they're promising you 125,000 or $1 million or what, who's falling for that? That's what I want to know. I really do want to know. I mean, if it sounds too good to be true, it is.
Yeah. And like the thing is too, like on Group Dynamite, like we didn't know that it was going to go up 5x in 7 months, but it's just like you said, it's a quality business. We're buying it at this time.
If you have 10 to 20 or 20 to 25 quality businesses in your portfolio that are trading at reasonable valuations that have growth profiles, if one of them does that, it can change your portfolio. Have a plan, stick to it. That is the way to generate wealth over the long term, not by getting some inside information or some, too good to be true ad that you see, because it is too good to be true.
I just want to know what fruit Kevin O'Leary is holding. I've been trying to figure that out. I don't know what AI is trying to make. If it's a melon, he's wiping it
kind
down.
Of looks like a melon.
Towel.
Yeah, I'm not sure.
Something's going on there. Whatever fruit AI has, that's what I want.
Yeah,
I mean, those are just going to get better and better and better. And we're gonna. If it sounds too good to be true, it is. It doesn't matter how good it looks. Like, I mean, I think there's one thing we should be teaching in school is common sense around financial issues, and that education will prevent these things. It's uneducated within anything to do with investments that causes a lack of skepticism. You should have a healthy degree of skepticism when you're looking at anybody who's saying that they can produce a tremendous long-term or short-term return for you.
Yeah.
Long-term.
Yeah, exactly.
The other one, which I was just going to mention, is the Telegram groups. I know I mentioned it to you probably a month ago. Brennan, is every once in a while I'll search up whatever company name. If you go to the news tab on Google, you'll see just direct links to Telegram groups, which are the same sort of scams which Brennan's describing, where they're hijacking the news profile through Google. There's any of those private Telegram WhatsApp group. Those, if you're going in those, they're most likely just going to be a scam. I never
beware.
Yeah,
beware.
Those are not legitimate platforms for really investment advice.
But yeah, I mean, it's interesting too. Just the reason I guess I really kind of started this is not only because I'm getting served these, is Brett brought up to me that the whole article that Reuters came out indicating like Meta is allowing this to happen and not wanting to clamp down because there's so much revenue coming in from these ads. It's really going to be interesting to see if that'll change, going forward, if there will be pressure. I would probably say that there won't be. It might be just such a hard thing to, clamp down on because of the scale. Like I was saying with that Vlad Tenev, the Robinhood CEO, I probably saw this exact same ad probably 50 times from 50 different accounts. And even if one got reported, they could probably, whip up a new account instantly as well.
I mean, part of that has changed based on the sitting administration, right? And the policies that are in place. I mean, if it's really punitive for Meta, if they get caught or if they put forth these ads that end up losing people money, then if it's extremely punitive, they're not going to do it. But
True.
if it's not, they're making good money off of it.
Yeah.
Yeah.
I know they don't have the incentive.
In 2021, 2022, I can remember the exact year, Meta did crack down on a bunch of crypto scam significantly,
Yeah.
and anything financial was really cracked down. But now they've seemed to completely have reverted, and then with AI and all that.
And the thing is, they probably went too far one way, and now they've probably gone too far. I mean, can we ever get a happy? Human beings are like, everything is like this. Whoa, whoa, whoa. It'll probably slap back the other way at some point, right?
True.
Yeah. Okay. Well, let's move on to our final segment, Your Stock, Our Take on Premium Brands. Interesting company that is expected to have a potential increase in aggregate earnings. Is it going to be on a per share basis? That has been the issue, on a per share cash flow basis for the business, but they did make an acquisition, and Brett's going to take a look at them. If they can drive per share, there could be something. If not, it probably is range bound.
Yeah, this is a company which we've been following for multiple years now. I was actually looking back at, we did a YouTube, last time I did a YouTube segment was 2022. This is, but we've looked at it, I think, every year I've been around. So it's been an interesting company, but it's always had high debt, low growth, and volatility, as well as some macro factors during the last period. But Premium Brand Holdings, PBH on the TSX, if you're not aware, they hold an array of specialty food manufacturing, premium food distribution, and wholesale companies. The company breaks its operations into 6 groups: seafood distribution, protein, sandwich, bakery, and culinary, which it then reports under 2 revenue segments: specialty foods and premium food distributions. The company operates in both Canada and the US, with the latest acquisition really being a push into the US. And the company is very acquisitive. They are constantly acquiring companies, and that is really a key feature to their operations. The stock is up to $102.50 a share, 28% over the past year, with a 3.3% dividend. So a good return over the past year, especially for a company which is slow moving like Premium Brands. But over the past 5 years, the capital return has been materially flat at 1%. So really only the dividend return during that time frame. It's been very volatile during that time period. There was big macro swings due to cost inflation post-COVID, and they initially were a beneficiary of it, then they saw the other end of it. And so then now we're looking into 2026, how they are going. The company has had just good absolute level of growth for both revenue and EBITDA historically over the years. But in the last 5 or so years, adjusted EPS has really plateaued, a bit of volatility, but relatively flat in comparison to EBITDA and revenue. They've done a significant amount of acquisitions, which has fueled a good portion of the revenue and EBITDA growth. But interest has pressured profitability in addition to share issuance in relation to the acquisitions, as well as there's been those other pressures on margins due to shifts in food prices. We can see leverage is still quite high at the end of Q3, with total debt to EBITDA at 4.3 times, with senior debt to EBITDA of 3.4 times, above the company's long-term target of 3.5 to 4 times and 2.5 to 3 times respectively. The leverage of the company has been a concern for us for years now, as well as other analysts. That's something that's been constantly highlighted for Premium Brands, and it continues at this time to create a drag on earnings. The debt is primarily originates from the billions in acquisitions over the years. Excluding the most recent acquisition, they've had $3.1 billion invested across 84 transactions since 2005. So a very acquisitive company. But following the quarter, they did do a big acquisition, just closing a few days ago at the start of January. They closed Stampede Culinary Partners, which was primarily funded by equity and equity issuance, so some directly to the previous shareholders of Stampede, but then they also did do some private placements at the time, but they did add 172.5 million in convertible debentures. That adds to the absolute level of debt. But since the majority of the funding was equity, leverage is actually expected to fall to about 3.9 times total debt to EBITDA on a pro forma basis. So deleveraging as they issued equity effectively. Going deeper on the acquisition of Stampede, which provides culinary solutions and a protein platform, the expected synergies include the standard cost synergies and utilizing capacity, as Stampede's facilities are only at about 60% capacity, as well as cross-selling opportunities, as the two companies have different channel focus, with Premium Brands focusing on retail, while Stampede focuses on family and casual dining. So you have some cross-selling opportunities in addition to cost savings, which is normally what you would expect with an acquisition. The total consideration was quite large at $663 million US, so just over $900 million Canadian, or $688 million US after working capital, of which $513 million in cash and $150 million in shares, the cash being partially funded by the issuance of subscription receipts for $322 million at $97.50, and $173 million in convertible debentures, with the remaining being drawn from the company's revolving credit facility. This puts the valuation of Stampede at 9.7 times expected 2025 adjusted EBITDA, or 7.5 times after the expected synergies, or 8.4 times after removing the impact of beef pricing, which has been quite high lately. The company does expect the acquisition to be immediately accretive on a per share basis in the mid-single digit range pre-synergies, which is great to hear. That is something which we do keep harping on over these years, is they need to be accretive and grow on a per share basis, which they've really struggled to. Overall, the acquisition does seem to fit, and it does seem like it will be an overall benefit to the company. It wasn't a poor acquisition, which we do see time to time. Now, just a quick look at the last quarter, Q3 2025. The company recorded record revenue of $2 billion, up 19.1%, of which 66.6%, so 2/3, was specialty foods, and the remaining third being food distribution. Growth was powered by strong organic volume growth of 10.3%, which is great to see. That post-COVID period had very low organic growth. Specialty foods volume growth had of 13.3%, and acquisitions adding $142 million and $73 million respectively. That's organic 142, acquisition adding 73, with the remainder just being price increases and foreign exchange impact. Furthermore, growth was powered by the US growing organic growth volumes of 24.3%, compared to Canada being effectively flat at 1%. Canada was weak due to poor beef jerky sales due to high beef prices, as well as a subsequent new product launch. Premium food distribution revenue increased 10.7%, with organic volumes growing 4.9%, so still growing, but not as nearly as strong as the specialty food segment. Gross profit margin did fall 120 basis points to 18.3% due to higher beef prices, as well as higher overhead to add capacity, recent acquisitions, as well as lower margin on lobster products being distributed. Adjusted EBITDA rose 12.4% to $179.1 million, a 9% margin, down from 9.6% in the prior year. And EPS grew 14.4% to $1.27 shares per share from $1.11, and that's adjusted EPS, I should say. Historically, the company has been relatively consistent at raising its dividend annually, but at the start of the year, they didn't at the start of 2025, as there was significantly high uncertainty around tariffs, so the company elected not to raise it. So we'll see again in this coming quarter, will they actually raise it? Because they were quite consistent every year. At the start of the year, they'd raise their dividend. They didn't do that. So we'll see in the coming quarter if they do that. The payout ratio is reasonable at this level at 55% of free cash flow. So that's not a concern for sustainability of the dividend at this time. For 2025, the company is guiding 7.4 to 7.5 billion in adjusted EBITDA, in revenue, and 670 million to 680 million in the adjusted EBITDA. And for the long term, out to fiscal 2027, the company is targeting 10 billion in revenue and 1 billion in adjusted EBITDA. Including leases, the company is trading at 12.5 times trailing adjusted EV/EBITDA and 11.8 times forward for this year, as well as trading at a trailing price to free cash flow of 16.7 times. Not absurd valuations, but not inherently cheap, not a screaming discount. Overall, the company has had good recent organic growth. It was very nice to see as an acquisitive company, as you want that organic growth and inorganic growth combination. That is always good to see. When you do have just inorganic growth, that can just really need to pressure from further acquisitions. And it can cause companies to really over leverage themselves, push themselves into poor acquisition. So organic growth and volume in their case, it's always great to see. But EPS has just generally been struggling in comparison to that revenue and EBITDA. That is something which we do want to see. The latest acquisition, at least it's accretive. That's very good. And now we want to see it. That's what they forecasted. Now we need to confirm that's actually the case. There's clear synergies in the acquisition, which is also beneficial. The company's valuation is reasonable at this time, but I would not call it a screaming discount, like I said. If someone wanted to take a position, the valuation likely wouldn't be a deal breaker at this time, but it wouldn't be the core thesis behind the company either, where it's just such a cheap valuation. It will be a story of, can management continue to deleverage and then produce per share growth and meet its long-term targets? And as for disclosure, we do not have a position or relations with the company.
Excellent. I mean, I think that's the crux of the argument. Are you going to see per share cash flow, per share earnings growth, which is something that kind of has lacked in the business? I think it's been well built, but the debt did get up to the higher end of that range. Can you deleverage and continue to grow? They've had a challenge growing in a per share basis and deleveraging at the same time. They're now issuing equity. Can they grow on a per share basis? That's the crux right now. If they can this year, then you could see continued strong returns after, it was good last year. It was a flat period. It was significant 3 to 5 years before that.
Yeah, and it's really that leverage is forcing them now to do more equity portion. Like, it's less of a choice, because if they were to do just purely debt, that would be too much leverage at this point. That's where you will actually get into solvency and liquidity concerns if you do see another, not necessarily COVID, but where they're really pressured during a 1-2 year period. That's why you can't have those 5, 6, 7 times leverage ratios.
Yeah, and this is why we are wary with companies that continue to have debt go higher and higher and higher over time, and they're not, paying it down. I mean, we had a company that was just acquired that it's Crawford United. I'll probably talk about them next week, but they would go into debt, pay off, and then you never had a situation where you were going to see them issuing shares to grow the company via acquisition, because they're growth by acquisition company, and you're always same amount of shares, higher revenues produce higher earnings. It's very simple, but they weren't acquiring 15 companies a year. They're a company 2, 3, maybe 1 if the cash flow wasn't there to pay out of to grow the business. So more disciplined approach. It's an approach that Firan, for example, which we've talked about on the show before, has taken, and we've seen the share price go from $1.30 to 10 plus. But it took 8 to 10 years. But you'll take that return over an 8 to 10 year period, 700-800% if you can get that. But it's a disciplined approach to growing. And like Buffett said, get rich slowly versus trying to get rich quickly and losing money. So you're gaining money over time. This is how you get rich. And, 10 years really isn't that long, to be honest, in the grand scope of investing. Anything further for the show this week? No. We got to get at it to prep for our predictions show next week. Maybe we'll even have a stock pick or two on that show. So we'll tease that, and we'll keep your questions coming in for our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis. If you're watching this, viewing this on YouTube, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, at first, a happy new year, and I wish you profitable investing. Thank you.
Happy New Year. Thanks, everyone.
Thank you.